P2P lending in India did not just directly become a regulated system, it grew thoughtfully, step by step, learning along the way. And that's actually its biggest strength. Between 2017 and 2024, India's P2P lending ecosystem evolved from an early experiment into one of the most structured and regulated models in the world. Welcome to episode 5 of P2P Lending Playbook. Today, we'll walk through how P2P lending in India matured over time. Understanding this journey will help you see why today's framework is really strong. In 2017, P2P lending in India reached an important milestone. The RBI formally recognized P2P platforms as NBFC P2P, giving the industry a clear legal identity for the first time. The intent was simple and forward thinking: allow technology platforms to connect people who want to lend with those who need credit, while keeping the platform itself neutral. These early years were about discovery and learning. Platforms focused on building technology, onboarding users, and understanding borrower behavior. Retail lenders were being introduced to a new concept called direct participation in credit. It was a phase of experimentation where the ecosystem began finding its footing. As adoption increased, RBI played an important role in shaping the industry's direction. Rather than reacting late, RBI stepped in early with clarifications to ensure the ecosystem developed responsibly. They reinforced a few core principles. Platforms are intermediaries, not lenders. Returns cannot be guaranteed. Credit risk must always be transparent. And fund flow must remain clean and auditable. These clarifications helped ensure P2P lending remained what it was meant to be: a transparent credit connecting ecosystem, not a substitute for deposit or guaranteed products. Then came the real test. The COVID period challenged every part of the financial ecosystem, and P2P lending was no exception. Borrowers faced income disruptions, repayments slowed temporarily, and lenders saw how credit behaves during stress. But this phase also proved something important. P2P lending wasn't fragile, it was adaptable. Platforms improved recovery systems, strengthened underwriting, and communicated more openly with lenders. The ecosystem learned how to function through uncertainty, an essential trait for any long term financial model. Post COVID, the industry entered a more confident and matured phase. Platforms began using deeper borrower assessments, including cash flow analysis and behavioral data. Loan tenures became more structured. Diversification became central to lender strategy. Most importantly, lender awareness improved. P2P lending started being positioned correctly, not as a shortcut, but as a disciplined credit based earning approach. Transparency improved, and dashboards became clearer. Performance data became easier to understand. This was the phase where the ecosystem started operating with intent rather than speed. By 2023 and 2024, the RBI updated its guidelines. The updated guidelines focused on consistency and clarity: tighter escrow timelines, stronger disclosures, clear lender risk acknowledgements, and better governance standards. These changes reinforced trust in P2P lending. They ensured that as the ecosystem grows, it grows responsibly with aligned expectations for borrowers, lenders, and the platforms. Today's P2P lending ecosystem in India is stronger because it has evolved, not rushed. Risk has not been eliminated, it has been understood, disclosed, and structured. Platforms operate within clear boundaries. Lenders know what they are participating in, and borrowers access credit through a transparent system. This is what healthy financial evolution looks like. And that's exactly what makes P2P lending in India a sustainable long term opportunity today. P2P lending in India today looks the way it does for a reason. Every rule, every disclosure, And every safeguard you see is the result of years of learning, testing, and thoughtful regulation. And that's what separates a temporary trend from a long term financial ecosystem. If you are lending today, you are participating in a system that is shaped by experience, a system that brings us to the end of this episode. In the next one, we will see what risk lenders should consider while lending. Until then, signing off.